Now, let's take a look at some of the factors that are supporting this kind of rally. Now, the surge is coming after the US government shutdown that has delayed key payroll data that is clouding the economic outlook, and hence gold demand is surging and the prices too. Now, traders are also betting on a 25 basis point Fed rate cut later this month, which is a move that typically boosts gold, which doesn't yield interest. Now, that's one of the factors. Apart from that, the central bank's diversification away from the dollar and massive inflows into gold-backed ETFs, that's the strongest in over 3 years actually. That's also continuing to fuel demand for gold. And a buy the dip mindset among investors in a weaker labor market outlook, they're also adding to the momentum for the yellow metal. In fact, analysts are noting that a potential short-term pullback may be likely. However, the broader bullish trend, that remains intact for gold.
Okay, so precious metals continue to inch higher in the global market and safe haven demand seems to be resuming, and that is precisely the reason both gold and silver are sitting at a fresh record high in the global market. In fact, not just global market, in the domestic market on MCX as well. But to discuss this in greater detail, we are now joined by Anindya Banerjee, Head Commodity and Currency at Kotak Securities. Anindya, afternoon, and thank you so much for taking your time out and joining us here on ET Now. We'll talk about oil in just a bit, but before that, let's talk about gold and silver. After the kind of up move that we have seen this year so far, I believe gold is now up nearly 40 to 45% on a year-to-date basis. Do you see more steam left as far as precious metal up move is concerned?
A very good afternoon, and thank you for having me. The last time I was on your show, I said the same thing, that the gold and silver is on a structural bull run. And of course, when an asset class does so well, there is a lot of hot money that also enters that particular asset class. And that's exactly what we have seen. So the underlying factor that's driving gold and silver is a kind of no confidence on the dollarized fiat system. So because the kind of expansionary fiscal and monetary policy we are seeing across the world now, with Japan also entering the same fray after their recently held elections, there is a clear inflationary pulse which is there, which the commodity markets are saying. Gold and silver is right at the forefront. Yes, it can continue to rise. On dollar terms, the next major level is going to be 50 on the silver. And this level, mind you, has been tested twice, almost. Once in 1980, another is 2011. Generally, we expect that particular resistance to break eventually. And over the next 1 to 1.5 years, we could see levels of 75 to $80 on the silver. As of now, short term on the MCX, 151 kind of levels will be the big resistance, which coincides with the sort of $50 mark on the spot silver. And on gold, the 4,000 is going to be a psychological barrier, but nevertheless is going to be a tough barrier. So I would presume 1,21,000 on the MCX is going to be a major resistance, 1,21,000, 1,21,500. Once that breaks, the next level to watch out will be $4,100. So the overall trend for gold and silver is very positive.
Okay, so overall trend for both gold and silver is positive. 4,000 will be a psychologically important mark for the yellow metal. But if you had to choose one with an investment perspective, gold versus silver, which one will you be more bullish on?
I would continue to advocate that have both, but one can tweak the weights. So it is basically rather, let's say 60% silver and 40% gold.
Okay, so 60% allocation to silver is recommended and 40% to gold. And let's also talk about oil because of the OPEC Plus announcement that came in over the weekend. Last week, oil fell nearly 8% in the global market. We've seen some bit of uptick today morning. It has now crossed that $65 per barrel mark because the output hike was lower than what the street was penciling in. But that does not mean that supply glut is out of the way, right? So where do you see the oil market going forward, and do you expect Brent to probably fall below that $60 per barrel mark in the next calendar year?
Right. So actually, the over the short term, let's say over the next couple of months, it's going to be a tug of war between the fundamentals, as you rightly said, that the supply glut is not going away, and America wants to also increase its supply. That's what Donald Trump has been saying for long. But it's a tug of war between the demand supply and the geopolitics. Now, the Ukraine Russia war is yet not resolved, but we have to also keep a watch on Gulf. In West Asia, again, the Iran angle is heating up. If there is a fresh confrontation between Israel and Iran, that can lead to a rise in the geopolitical premium and can support oil prices over the short term. If I take Brent as a benchmark, then I would say 64 is a very 63, 64 is a very strong support. Now, if that breaks, we could see a lot of technical selling, but as of now, 63 kind of level is a very strong support, and $60 on the WTI, on MCX around 5400, and the upper side is capped around $70 on the Brent. So this can be the range for the time being, but for the short term, keep an eye on Gulf and West Asia because things are heating up again.
Understood. So 60 to $70, that's the range that you're working with. But Anindya, if you can tell us any factor that you're watching out for that could probably push Brent below that $60 per barrel mark or above 70 in the global market?
See, I think the overall supply situation is quite supportive for lower prices. But the point is, if I strip away the geopolitical premium, then the prices should be much lower. But the geopolitical premium is supporting it. Now, if there is a quick resolution to the Ukraine situation, yes, the oil prices can come down because that can create the possibility where the Russian oil flows into the market officially. So that will be one trigger. But as I said, again, just keep an eye on West Asia.
Okay, so keep an eye on West Asia. That's the word coming in as far as oil market is concerned. But Anindya, I also wanted your thoughts on the copper market. Last week, copper on LME surged nearly 3%. In fact, it did briefly cross that $10,500 per ton mark. If you can tell us, do you see more steam left? I understand the up move is on account of supply concerns. But do you expect that to extend going forward?
Right. In fact, copper market is very well positioned to play this monetary and supply crunch both. Because on one hand, we have a situation that demand and the prospect for demand from the electrification, the new economy is going to increase for copper, and the supply constraints are very much a real thing. So that will continue to drive prices. And as I said, the overall metal market, the hard asset market, is basically saying that they are anticipating a dollar devaluation in the coming over the next coming years. And also it's building in that kind of inflation from the expansionary fiscal and monetary policy. So if I look at that, the conjunction is copper, and copper prices can continue to rise. If I use MCX as a benchmark, I won't be surprised in the coming months if copper scales to 1100 rupees level, currently around 995 levels.
Understood. So that's as far as copper is concerned. And India, thank you so much for taking your time out and joining us here on ET Now and helping us understand what the outlook is, not only with respect to precious metals, but also for the oil market and other industrial metals. Thanks so much for taking your time out and joining us.